Stock market and its types. Investing in stock is gambling. There are some myths and misconceptions about investing in stocks. For a better understanding of what it really means to be a stock investor, be sure that you know the truth behind the myths. Whether the stock market is gambling or not depends on how you approach it. Of course, if you simply pick the stock at random and merely rely on pure luck to be successful, then you are gambling. However, if you approach the stock market professionally where you put in enough time, effort and research in your every transaction, then you are not gambling, but investing. Gamblers rely on luck, while true investors know what they are doing and have an edge over the stock market. Investing in stock is just like any other business. You can make money, however, you can also lose money. Like any investment, there are risks involved. Indeed, there are people who are able to grow their money, but there are also investors who lose their money. To be successful, you need to understand the stock market and apply certain strategies. Of course, the major part of success is to conduct serious research. Some people think that you can only invest in stocks if you belong to a particular group. This is not true. The stock market is open to everyone, provided you are of legal age, and there are no other prohibitions. One thing to always keep in mind, when we are talking about financial markets, there is no hard and fast rule. Sometimes there are sensible reasons behind every trade, and sometimes there are speculations that make very little sense. Yet sometimes there are just purely emotions that came into play where fear and greed hooked up. There is no one-size-fits-all philosophy. Day traders and pure investors believe in different investing horizons. Stock market is an umbrella term representing all of the stocks that trade in a particular region or country. Thus, it is a place for buying or selling stocks. It also acts as an indicator of the economic cycle. When the economy is doing well, the prices of the stocks tend to increase, generally. However, when the economy is down, you can expect the prices of the stocks to decline. This can be true for a very good stock. It is also worth noting that the prices of the stocks primarily depend on the performance of the business. The stock market is not a place you can visit, but refers to the trading, some physical, most online, of shares representing the partial owning of companies. It's not only where businesses raise capital, but is used as a sign of the economy's health. When people talk about stocks, you may hear them talk about how the market rises or falls in a day. However, when you take a look at the stock market, you may see that not all the stocks rise or fall on that day. The way to understand this is to know the stock market index or indices, plural. A stock market, equity market, or share market is the aggregation of buyers and sellers of stocks, also called shares, which represent ownership claims on businesses. These may include securities listed on a public stock exchange as well as stock that is only traded privately, such as shares of private companies that are sold to investors through equity crowdfunding platforms. Investments are usually made with an investment strategy in mind. There are basically two types of share markets, namely primary market and secondary market. Primary market and secondary market are two distinct stock trading process. 1. Primary market. The primary market refers to the market where shares are issued for the first time by companies seeking to raise capital. The shares are bought by the investors directly from the company or through the underwriter, in an initial public offer, IPO. The proceeds of the issuance of shares go to the company. Therefore, the primary market is crucial for businesses that need to raise funds through equity financing to start or expand their operations. 2. Secondary market. The secondary market, on the other hand, refers to the market where existing shares are traded among investors after initial public offering. The shares are sold and bought amongst the investors, without the participation from the issuing company. The prices of the share in the secondary market are primarily based on the supply and demand, and they can fluctuate based on the market conditions. The secondary market is important to investors who seek to buy or sell securities to realize the capital gains or losses, depending upon the market conditions. The secondary market can be further broken down into two specialized categories. Auction markets. In the auction market, all individuals and institutions that want to trade securities congregate in one area and announce the prices at which they are willing to buy and sell. These are referred to as bid and ask prices. The idea is that an efficient market should prevail by bringing together all parties and having them publicly declare their prices. Thus, theoretically, the best price of a good need not be sought out because the convergence of buyers and sellers will cause mutually agreeable prices to emerge. The best example of an auction market is the New York Stock Exchange, NYSE. Dealer markets. In contrast, a dealer market does not require parties to converge in a central location. Rather, participants in the market are joined through electronic networks. The dealers hold an inventory of security, then stand ready to buy or sell with market participants. These dealers earn profits through the spread between the prices at which they buy and sell securities. An example of a dealer market is the Nasdaq, in which the dealers, who are known as market makers, provide firm bid and ask prices at which they are willing to buy and sell a security. The theory is that competition between dealers will provide the best possible price for investors. Both markets offer investors opportunities for capital appreciation strategies and market outlook. Third and fourth markets. You might also hear the terms third and fourth markets. These don't concern individual investors because they involve significant volumes of shares to be transacted per trade. These markets deal with transactions between broker-dealers and large institutions through over-the-counter electronic networks. The third market comprises OTC transactions between broker-dealers and large institutions. The fourth market is made up of transactions that take place between large institutions. The main reason these third and fourth market transactions occur is to avoid placing these orders through the main exchange, which could greatly affect the price of the security. Because access to the third and fourth markets is limited, their activities have little effect on the average investor.